we were actually calling interest, and the amortization that under IFRS we were calling amortization of an asset, we're going to add them together and put them into one line, which will be equal to the lease payment. Why? Well, this, even though we're not calling it interest, will be equal to the interest we saw under the IFRS treatment. This is the lease payment in total minus that interest. The two together must come to the lease payment. That entire lease payment is CFO. So it's really not a huge difference fundamentally. We're still starting off in the same place, but it's how the asset and the liability change over the life of the lease, and how the interest and amortization are reflected instead as a lease expense in the income statement. Let's see it in action. So here we have the exact same lease, except now we're going to call it an operating lease under US GAAP. Where do we start? We start in the exact same place with a right of use asset of 37,909, which would be matched by a lease liability of 37,979. No difference so far. In fact, there is no difference in the lease liability at all. That 37,979 will then be amortized using the effective interest rate method. So even though it is now an operating lease, look, the lease liability goes 316,987 to 248,173,909 down to 0, which is exactly what it did when it was a finance lease. So there is no difference on the liability side. The only difference we saw on the previous page was with the asset. It's 379079, but the amortization we charge on the asset is the lease payment minus interest. So let's just track that in year one. The lease payment every year, remember, under this lease was 100,000 yen. What is the interest expense in year one? Well, let's just track the lease amortization. Same under the finance and the operating for the lease liability, which means we're going to get the same interest. So 37,908, 31, 24, 17, 9. In year one, it's 37,908, which means a principal payment of 62,092. Again, exactly as we saw on the previous page. That now becomes the amortization of our right of use asset. And look what that means. 37,909 less the 62,092 gives us 316,987. 316,987. We now have a difference between our operating and our finance treatments. We no longer have an asset that is different to the lease liability. Under an operating lease, they are identical at the end of every year because we're writing down the liability by the principal payment and we're amortizing by the principal payment. Once again, you can track that through every year. What you'll see is the asset and the liability track each other different. Different to the asset under the finance lease. What does it mean for the income statement? Once again, quick reminder, under the finance lease, we charged amortization straight line, and we had interest using the effective interest rate method. That gave us, and this is interesting to note, for the 5 years, a total interest expense that gradually fell. Started at 113, fell all the way down to 84. Now, I think this is important. Let's add those up over 5 years. Just take a breath, take a pause for a moment before you add it up. See if you can guess what that's going to come to. We've paid 500,000 for this lease. In total, we are going to charge the 500,000 to the income statement. So those five add up to 500,000. But it's much higher in year 1 as a total expense than year 5. Why? Well, it's nothing to do with the amortization because that's straight line. It is the interest. Using the effective interest rate method, as the liability falls, the interest charge falls. Hence, you see this decreasing total expense. Now, onto the operating lease. Same total expense, $500,000, but it goes through in equal amounts, which means early on, it is lower than the total expense under a finance lease. Later on, it is going to be higher. Why is it constant? Because we forced it to be constant. We forced it by charging amortization equal to the principal repayment, which means we have amortization of the principal repayment. We had interest of $37,908, $100,000. That's for year 1. Again, track it through. You'll see the same thing happens every year. Now, in the cash flow statement, if it is an operating lease, we charge the $100,000 as an operating cash flow. All going to hit CFO as an outflow. Under a finance lease, it is split. And remember, this is US GAAP, so there's no choice here. Interest is going to CFO. The principal amount to CFF. If it's an operating lease, we therefore have a much higher hit to CFO than we do under the finance. In total, the impact on the cash flow is the same. Now, that's everything on how we account for leases in the lessee's accounts. Let's just clean up the screen and take a look at some ratio analysis. Always focus on the analysis. That's where the good fun is. And we'll take a look at 3 ratios and compare and contrast how the accounts would look if we treated a lease as finance or as operating. Let's start with the EBITDA margin. EBITDA divided by revenue. Revenue is no different between the 2 treatments. Obviously, we're not touching that. But EBITDA will be affected by the different classifications of expenses that we're using. Let's start with the operating lease. In the income statement, the operating lease charges $100,000 each and every year as lease expense. All of that is an operating expense. All of that therefore reduces EBITDA. If, on the other hand, I'm looking at a finance lease, 75,816 just to take year 1, 75,816 is amortization. If we're looking at EBITDA, EBITDA is not impacted by amortization. Obviously, it's before amortization. And interest is the rest, the 37,908. EBITDA is before interest. So neither the amortization nor the interest will hit EBITDA. Therefore, if I treat this as an operating lease, that margin will be lower. What about asset turnover? We're talking about asset turnover here during the life of this lease. Asset turnover, revenue generated divided by your asset base. Should be average assets. We don't need to go that far. We're just proving a point here about higher versus lower for these 2 treatments. Let's again start with the operating lease. No impact, as we've already said, on revenue. But year by year, compare and contrast the balance sheet. If I have an operating lease, my right of use asset here was $316,987 at the end of year 1. If, however, it was a finance lease, the right of use asset was only $303,263. And you can see that tracks all the way through. The asset under the finance lease treatment is always at a lower value. What does that mean? Well, back to my operating, my asset base is higher. Why is this? Well, it's because in the operating lease, we're amortizing that asset using the interest each year, as opposed to the straight line amortization, which is a lot higher. So my asset base at the end of year 1, 2, 3, and 4 is higher under my operating lease treatment, which means this ratio will again be lower for the operating lease treatment. And finally, just quick mention of cash flows. Common measure analysts will use is cash flow per share. That cash flow is usually CFO, seen as a more robust measure than net income per share if you've got concerns about some of the accruals accounting going on in the income statement. Once again, if you look at the operating lease treatment, we have hammered CFO with 100,000. The finance lease treatment, only 37,908 hit CFO. So CFO again is going to be lower. Hence this ratio will be lower if I use the operating lease treatment. Overall, at the end of 5 years, it comes back to the same total expense. Cash flows going through in total are the same, but the categorization between amortization, interest, or operating expenses is different over the life of the lease. Hence, you get fundamental differences in your ratios. So that's everything we need to say about lessee accounting. Let's move to the other side, lessor accounting. Lessor, remember, is the company that's allowing you to use the asset. Maybe an investment property company if we're talking about leasing our office space, warehouses, etc. Some good news. The treatment under IFRS and US GAAP is pleasingly similar. There aren't too many differences to worry about. To be fair, under US GAAP, if we decide we have a finance lease on our hands, there are two terms that US GAAP will use to describe that finance lease. It could be a sales type, or it could be direct financing. Sales type, if this is more of a one-off, it's not your general business to be leasing this equipment. Direct financing, if that's what you do. You are just a company that makes these deals for leases. However, it makes no, and to quote the curriculum, to quote the module, no material impact for us as analysts. Therefore, it's not something that's in the curriculum, so we won't spend time going over it. Where there are differences is between the treatment for both IFRS and US GAAP, so they're the same, but there are differences between a finance lease and an operating lease and how they are treated. So let's take a look first of all at how IFRS and US GAAP would treat a finance lease. At inception, first thing to say, we bring in a lease receivable asset at the PV of all future lease payments, which we then reduce by the payments we receive and account for using the effective interest method. This is just the mirror image of the lessee liability. And you'll see that when we go back and revisit Proton. The lessee has a liability that they gradually use the effective interest rate method to amortize. We have an asset. Because we've received that asset in return for, in substance, selling the underlying, we have to de-recognize the leased asset, remove it from the balance sheet. We put the PV of the payments receivable in, and we take out the underlying asset. Any difference at inception would be a gain or loss. During the life, we'll recognize interest income. We've brought in the PV of the payments there. The interest income will come in over time. If it is your primary activity, if that's what you do, that will all be revenue. And all cash flows go to CFO, which is fairly straightforward. That's the finance lease. It's worth just pointing out, it kind of ties in, it mirrors, as we said, what the lessee is doing. Finance lease in substance looks like you've purchased an asset with finance. So from the lessor's point of view, we make it look like we've sold the asset on finance. Hence, we receive the flow and get rid of the asset. If it's an operating lease, however, we do not do that. An operating lease in substance just looks like a rental agreement. doesn't look like anyone's actually bought the asset. So for example, you're just holding it for a tiny part of the asset's life. You're going to give it back. Other people use the asset. Therefore, we do not remove the asset from the lessor's balance sheet. It stays there. And all that happens is we recognize the lease revenue on a straight line basis. If the revenue we get is an equal cash payment, we just directly bring the cash payments in, as we'll see with Proton. If they are variable, so we get more cash in year 1, less in year 2, we'll just smooth it and put it in straight line. But that is it. We don't have to do anything over here. With a lease receivable asset, we do not remove this asset. We just quite simply have lease revenue, which goes to CFO. Really straightforward. Let's take a look. We are back, as promised, to Proton. Exactly the same lease. How are the lessor's financial statements affected by classifying as finance or operating? Let's start off with operating. It's the easy one, so we can knock it out in about 3 seconds. We keep the asset. So check the balance sheet for operating. We have kept the asset. And we'll simply depreciate it down to 0 over its life. We appear, if it's in there at the moment, at 350 to be charging 70 a year. 350,000, straight line basis over 5 years down to 0. Yep. 350,000 over 5, 70,000 a year. So we keep the asset charge depreciation expense. What do we see in the income statement as a result of the lease? The payments, because they were straight line anyway, just go straight in as revenue and hit the cash flow. As promised, not much to it. Finance, slightly more exciting. In substance, in a finance lease, we have sold the asset, so remove it. You can see there from the finance lease extract from the balance sheet, there is no asset anymore. It's gone. It has been replaced. So the asset is removed. It is replaced with a receivable. Here is the lease receivable. Those numbers should look familiar. That is the mirror image, as we said, of the lessee's lease liability. So go back, check the numbers, do the TVM. You'll see those exact numbers, but a liability for the lessee. And in the income statement, interest revenue over time, again, will look familiar. Remember, at time 0, we brought in the receivable at 379,079. So the first year's interest charge for the lessee at 10%, which is now the first year's interest income for the lessor at 10%, was 37,908. And again, you can track that each year. So not too much to say about lessor accounting, but you do need to know the difference between the operating treatment and the finance. It revolves around whether we de-recognize the asset and replace it with a receivable, or simply have a stream of lease revenue. Next up, explain the financial reporting of defined contribution, defined benefit, and stock-based compensation plans. We are in the world here of employee compensation. And there's a few different types listed out, some of which are tricky to account for, some of which are not. Let's start with the not. On the left, salary, bonus, health and life insurance premiums. These usually vest. That's a word we're going to see throughout this module. Vest means the date. So the date at which it vests is when the employee becomes entitled to it, when they've earned it. These simple forms of compensation vest immediately or shortly after the grant date, or shortly rather, after the grant date, so when you were granted it. Therefore, they're just reported as an expense in the period in which they vest. You work the year, you earn your salary for the year, you get paid the salary for the year, end of story. Or, for 2 weeks or for a month. So not much to say there, they just mention it, so we've got a complete story. Our entertainment is on the right-hand side. Defined contribution, defined benefit pension plans, and share-based compensation. A couple of exciting things to say. First of all, they are deferred. So we earn compensation in the current period, but receive it in the future. Obviously, you get your pension once retired. and it may be based on future variables. So for the pension, things like final salary will impact how much you get as a pension, and for share-based compensation, clearly the stock price. Now I say some are tricky, some are not. To be fair, defined contribution plans do not give us any accounting headaches at all. In a defined contribution plan, the company pays into the plan and has no further obligation. That's it. So they might match your contributions into a plan. It gets invested, maybe well, maybe badly. And then when you retire as an employee, you go to the fund and you see what's in there. Hopefully it's been invested well and it's grown to quite a healthy pot. Sometimes, as in the case of the first firm I worked for, the fund has completely collapsed and there's nothing there. No comeback to the company. It wasn't their obligation. They just said, we're paying in. Let's see what happens. In my case, what happened was it all disappeared. But because there's no obligation, really simple to account for, the payment is recorded as an expense in the period. Whatever was paid goes in as an expense. The only time you'd see it hit the balance sheet is if some of that payment that is due is still outstanding at the year. You get a little accrual. Apart from that, nothing to talk about with defined contribution. However, defined benefit plans, a little bit trickier. With a defined benefit plan, the company does have an obligation because it promises a value of future benefits to be paid in retirement. Great news for the employee, big risk for the employer, which is why employers don't tend to have them anymore. But there are some big historic plans still in company accounts that can represent a huge percentage of assets and liabilities on the balance sheet. So it's worth looking at for that reason, plus all of the assumptions that are in there, which can have a big impact on ratios and profits for the year even. For example, a classic defined benefit plan might say this: when you get to retirement, we promise to make an annual payment during retirement until death equal to the number of years service you gave the company divided by 60, I'm just making this up, multiplied by your final salary. Look at all the assumptions that have to go into that. During retirement until death, how long is that? How many years service are you going to give the company? What will your final salary be? There is a lot of assuming going on. Now, accounting-wise, what does all this mean? Well, if we have an obligation, then we must record that obligation as a liability. The obligation goes into the company's balance sheet at its PV, the present value of the future obligation. Present value, so it needs discounting. It will be discounted at the yield on a high-quality corporate bond. We're not, in theory, taking big risks with this pension fund. And the assumptions significantly affect that obligation. This PV of future obligations can change dramatically given changes in your estimates of any of these, plus the discount rate you're using. So we have an obligation, but it's not fair to the company just to say, look, you've got to show that you've got this $3.8 billion that you've got as an obligation to pay in the future. Because the company will turn around and say, well, hang on, I've actually got a big pot of assets that I'm holding back to fund that pension. So what we'll do is also show the fair value of plan assets in the company's balance sheet. These assets are likely to be held in a separate legal entity, a separate pension trust fund, but they will be shown netted off, which is exciting. We don't get to net things off very often with accountants, but they will be shown netted off against the PV of the future obligation in one line. How does the pension actually work? Well, the company makes payments into this fund. They're invested until they're needed, and then the fund will actually make the pension payments as required. In the meantime, what does the company have to show? One line. If the present value of the future obligation is greater than the fair value of plan assets, not great, but fairly common, then the pension fund has a deficit. That net figure, so can't stress highly enough, you don't show the assets and the liabilities separately, you show a net figure. Here, a net pension liability will be shown on the company's balance sheet. if the present value of the future obligation is less than the fair value of plan assets, you have a surplus. Great news. And that surplus will be shown as a net pension asset. And that does it for balance sheet reporting. But what about the flow for the year? We know the position is shown as a one-liner. What do we do with the movement over the year? The change in the asset, the change in the liability. So the returns on assets, how do we account for that? The increase in the liability, how do we account for that? Well, in one of two places. Some of the movements go through the income statement. Some of the movements go through other comprehensive income, OCI. And the real joy is that IFRS and US GAAP differ in how they treat them. Let's start with IFRS. On the left, what goes to the income statement as a result of this pension plan under IFRS? First of all, the service cost. What is the service cost? It is the present value increase in the benefits earned by an employee in the year. So if you think back to my earlier example where your pension was the number of years service over 60 times final salary, keeping everything else constant, just the fact that as an employee you have worked for one extra year means that you are entitled to a greater pension. That will increase the present value of the firm's obligation. Secondly, IFRS will also include past service costs, sometimes referred to as prior service costs, in the income statement. They are costs that result from changes in the plan rules. So this time, same example, my number of years service over 60 times final salary. Let's say the union has negotiated, so that plan rule now says number of years service over 50. All of a sudden, bang, everybody in the scheme, everybody in the plan is now entitled to more pension. One big jump in the present value of the obligation that also is part of service cost in the income statement under IFRS. Net interest expense or income, one line. Notice more netting. One line, net interest expense or income. That is the change in the PV of the net pension asset or liability, depending on whether you're in surplus or deficit, due to the passage of time. What do we mean by that? Ignoring any increase because of extra obligations earned, extra pension earned. Simple fact is, if your obligation is now closer to being paid off, its PV is going to be higher. A ridiculously simple example, take $100 and divide it by 1.05 to the 9 years. Take $100 a year later, 1.058. If you're due to pay $100 in 9 years, the PV of that is less than the PV of $100 due to be paid in 8 years. Obviously here discounting at 5%. So just because we're getting closer, the PV will increase. That is shown in IFRS income statement as one line of net interest expense or income, calculated as your net pension asset or liability times the discount rate being used. What goes into OCI? What IFRS calls remeasurements. And it's mainly to do with this, actuarial gains and losses from changes in assumptions. So the average service life, future salary increases, how long people survive as pensioners, the discount rate, and so on. If the actuary updates any of those, then the PV of your obligation will change. The argument is that's just noise. Everything that's in the income statement is expected and predictable and nice and smooth. Okay, you might be shouting at the screen, that doesn't really work for past service costs. I kind of agree. But the argument is, as your liability grows, as people work steadily for you year by year, those are expected and smooth costs. The income statement can take them. Changes in assumptions are noise. They're choppy. They are kept out of the income statement and shown in OCI. Still going to hit equity. OCI will still impact equity, but it keeps the noise out of the income statement. The argument is over time, they should even out. Secondly, any difference between the actual return on assets. So this is a big point in pensions. The actual return on assets is not shown in the income statement. For the same reason again, it's going to be very noisy. This scheme, this pension plan might have a 30, 40, 50, 60-year life. Over that 60-year life, the actuary is probably going to get the expected return on assets right, give or take. But year on year on year, there are going to be massive variations. Those variations are kept in OCI. So what we do instead is put an expected return on assets into the income statement. How does IFRS do it? It uses the discount rate. When it calculates net interest expense or income, it's doing it on the net pension asset or liability. If we were to break that apart, what we're effectively doing is taking our plan assets multiplied by the discount rate, the PV of our liability multiplied by the discount rate, and netting those two off. So we have taken a return on assets into the income statement using the discount rate. The difference between that and what we actually got, that's the noise, that's in OCI. Now, that's pretty much all we need to say from an IFRS point of view. Just be aware there are no numbers, no calculations here at level 1 for pensions. This is a scene setter. At level 2, pensions is a big topic. So we're really trying to get the idea, the concepts into your head without going on and calculating any of this. So from your point of view, what you want to focus on is A, the split between income statement versus OCI, and B, the difference between IFRS and US GAAP. So let's hit US GAAP. Same again, we're splitting between income statements and OCIs. It starts off very similar, the service cost under US GAAP, a nice, predictable, smooth cost, will go to the income statements, exactly as for IFRS. However, what's conspicuous by its absence there is past service costs. Past service costs go to OCI. So that is difference number 1. It goes to OCI and then gradually it will be amortized back into the income statement. Same logic. It's choppy. It's a little bit of noise. IFRS didn't mind that noise in the income statement. US GAAP does. So because it's too noisy, because it can be a bang, one big, huge one-off jump in the obligation, put it into OCI and gradually drop it into the income statement. Moving on. Interest expense, here's another difference. Interest expense is shown separately from the expected return on assets. Under IFRS, these two are combined into one line. Interest expense is interest accrued on the obligation using the discount rate. That's exactly as it was for IFRS. Remember when we broke it apart for IFRS, we said they were taking the obligation times the discount rate, the assets times the discount rate, and netting those two together, showing them in one line. We've got them on two separate lines. And what's more, when we try and calculate the expected return on assets, we use in US GAAP an expected rate of return, which is not necessarily the discount rate. Another difference. So show them separately and don't necessarily use the discount rate. In OCI, actuarial gains and losses, they don't call them remeasurements, they're just actuarial gains and losses. Same as for IFRS. All your gains and losses on the obligation. Sort of the same as IFRS. We take the actual return on assets less what we put into the income statement. So that concept is the same, but as we've said, be aware the return on assets we put into the income statement may be different. So this difference may be different. Those actuarial gains and losses in OCI are typically then amortized into the income statement over time. You get a choice of the time period you use. And to be fair, you also have the choice of dumping all of this straight into the income statement. But the usual approach is to leave it in OCI, at least initially, and then amortize. That didn't happen with IFRS. That's the final difference. Under IFRS, OCI is like Vegas. What goes to OCI stays in OCI. Under US GAAP, all the noise is held there and then dripped gradually, if it's big enough, and we'll talk about this at level 2, but if the balances are big enough, they'll be dripped gradually into the income statement. And that's it. That's really all we need to know for the world of pensions for the moment at level 1. There's not a lot in there. Focus, as I say, IFRS versus US GAAP and income statement versus OCI for both. But let's move on. To finish off the employee compensation section, we've got to talk share-based compensation. So what have we got? First of all, why we bother? The aim of share-based compensation, align employees' interests with those of shareholders. Shareholders want to see their wealth increased. How does their wealth increase? Share price goes up. So if you give employees shares, all of a sudden their main aim is to increase the share price. Does it work though? Does an employee honestly come to work with a skip in their step and think, I need to increase the share price today? Because in 5 years' time, if the price beats this other price, I might get a little bit of extra compensation. That is arguable. Another potential advantage, don't have to pay out cash. It's compensation, but the company doesn't have to pay out cash. Potentially. There are forms of share-based compensation that do involve cash. Potentially they don't, but it is still compensation expense. So we still, as accountants, have to figure out how to get that into the income statement. Also worth noting, it's got the potential to dilute EPS if you're issuing shares as a result of share-based compensation. You may well dilute EPS, so something you often see when calculating diluted EPS, as you will do in that module. Maybe cash settled. There may just be cash compensation linked to share performance. And this is the big one. This tends to be restricted to, the C-suite and senior management, and it may cause them to be risk averse. They don't want to do anything risky, take on massive risks, because that's got the potential to hurt the stock price. Conversely, if you're granting share options, remember options, or I say remember if you've not studied them yet, options have limited downside. And in this case, you've got the right to receive shares, so it's really a call option, unlimited upside. If at the moment the share price is so low that your options are worth nothing, or you've got nothing further to lose, you take excessive risks to try and get big gains. So, some advantages, some drawbacks. Let's look at different types. First of all, stock grants. With a stock grant, you are granting, as the name suggests, stock. The compensation expense, therefore, is based on the fair value of stock on the grant date. So you grant it. At that date, you measure its fair value. Shouldn't be too tricky, because the stock is trading, so you can go and look at its fair value as its market price. Clearly, if it's not trading, then you've got a valuation exercise to undertake. The expense is then recognized over the plan's vesting schedule. How long does it take for the employee to earn the right to receive this stock? Could just be an outright grant, so it's over a service period. It will vest over 3 years. If you stay with the firm for 3 years, you get the stock. Let us spread the expense over those 3 years. If it doesn't specify 3 years, it's just the current period. Could be restricted. It's allocated over a service period again, but related to performance. So it may be your performance, more likely it is the company's performance. Some sort of measure of earnings, returns, who knows. But in both cases, you spread it over the period, either just the service period required to vest or the period over which you have to perform to get those restricted stock units. What about, though, stock options? Stock options, compensation based on the fair value of the option on the grant date. Now that is more exciting. I said, very throwaway. Well, if it's stock grants, you're directly giving stock. You just value the stock, see what it's trading at in the market. Dead easy. If it's not trading, okay, exercise. It's even worse for options. If there are no options trading, obviously you need to value them. But even if there are options that are traded on this company's stock in Chicago, wherever, you still need to get the fair value of these options, because employee options, employee stock options are a very different beast than traded options. Just think liquidity, etc. So, how are you going to do it? There is no specific model that the standards require. Suggestions, Black-Scholes, binomial, any model that is widely accepted. That's all the standard is really trying to say. So it should be a model that is consistent with fair value measurement, is based on established principles of financial economic theory. That's where these come from. It should reflect all substantive characteristics of the award. So every factor that should play into the value of the stock option is taken into account. If there are factors that are yet unknown, wait until they are known before you come up with a valuation. Key inputs, and we always love it when the curriculum comes together. If you've not yet seen the derivs module, if you're going through it in a kind of sensible order, you may well not have done yet, but you'll see these key valuation inputs into options generally, certainly for exercise price, volatility, life of the award, to a certain extent dividend yield, risk-free. They all have an impact on the value of the option. The higher the exercise price, as that increases, the lower the value of the option, because the employee has to pay more to buy the stock. Volatility. Volatility increases the value of options. Limited downside, bigger upside. The life of the award. How long is it until the option is going to be awarded? The estimated number of options that we forfeited. Not really something we look at in derivs, but worth mentioning here. We said you might have performance criteria that you need to meet. If they're not met, well, you may need to take the options away. People may leave the company during the vesting period and they will never actually vest. Dividend yield impacts the price of an option. If the stock is paying out cash before the employee can buy it under the exercise date of the option, that will impact its value, as will changes in the risk-free rate. Higher risk-free rates tend to benefit the value of a call option. And again, we'll talk about those when we get to derivatives. The point here really is not can we learn how they impact, because we'll learn it in derivatives. It's to point out that yet again, we're in the realm here of assumptions and how assumptions can impact your net profit for the year, in this case via your stock-based compensation expense. So now we've defined it, let's talk about how to account for it. We've kind of touched on this a little bit, but let's just see it on a nice little timeline. There will be a grant date for the stock option, and there'll be a vesting date when it is earned. The gap between the grant date and the vesting date is the service period. Compensation expense is recognized over that service period. So our job at the grant date is to calculate the fair value of that option. Once we have that fair value calculated, that becomes our compensation expense and it's recognized over the period. If it takes 3 years to vest, you spread that fair value over those 3 years. What does that do to net income? Obviously, it's compensation expense, therefore, it reduces net income. But this is the world of accounting. There has to be another side to it. The other side goes to additional paid-in capital. Additional paid-in capital is part of equity. So although you're reducing net income, which will reduce retained earnings, which will reduce equity, the other side is adding to equity. There is actually no impact to equity of accounting for these stock options overall. It will, however, during the service period, reduce net income. That hit to net income is offset by the increase in additional paid-in capital. Now, once they have vested, the employee then waits until the exercise date. There's probably a range before eventually they expire and you can't exercise anymore. But on the date they are actually exercised, do not be fooled into saying, oh, we need to recalculate fair value. No, the price of the share, hence the fair value at the exercise date, is irrelevant. The value of the compensation expense that we gave was there at the grant date. So you do not recalculate here. All you do is record the cash that we receive. There's an exercise price and the employee pays us. And on the other side, adjust additional paid-in capital. And finally, cash settled share compensation. We said earlier that most share-based compensation doesn't involve a cash outlay. Cash settled obviously does. The one we need to talk about really is stock appreciation rights, SARs. It's a reward for an increase in the share value without actually issuing shares. So all you do is track the performance of your share. And if it increases, so the company's share price is increasing, then the employee gets a cash reward. You don't issue the shares. You just say, oh, look, our share price went up. If it goes up by 5%, then you'll get X as extra compensation. Now that's if you've got actual shares out there to track. If you don't, phantom stock plans do the same thing, but don't actually track your shares because maybe you're a private company without shares that issue. So you have these phantom units and you track the value of that unit, which is based on the company's performance, and your compensation is tied to that. Advantage, they have limited potential to induce risk aversion. They are more like options. You get extra compensation if the share price rises, but you don't get hurt if it falls. So if you were senior management, it would actually go the other way and again, perhaps induce risk taking. Treatment, once again, the fair value is allocated as an expense over the service period. And that's us done. In terms of accounting in this module, we've done leases and we've done pensions and share-based compensation. The only LOS that remains is this: describe the financial statement presentation and disclosures relating to long-term liabilities and share-based compensation. So nothing extra to account for. We just need to see what is in the accounts. Well, here we go for leases. On the balance sheet, we've already said you'll see a right of use asset and you'll see a lease liability. They may not be separated on the balance sheet if the company doesn't have enough of them. They may just be grouped into other, which is where you'd need to go to disclosures, to the footnotes, and find out what's going on. Look at this list. Don't spend hours rewriting this list. Just think, is there anything particularly that jumps out in there, or is it fairly obvious stuff? I think it's obvious. I want to know, what's the carrying amount of my assets by class? What did I spend? What's the interest expense? What's the depreciation on those assets? What my additions during the year? So really you're reconciling what was it at the start of the year, what was it at the end, and what caused the movement. What I spent, the interest, depreciation, and so on. And you need what the standards call a maturity and qualitative analysis of lease liabilities and activities. So the nature of the leasing activities, nothing more specific than that. Future cash flows to which the lessee is potentially exposed. That's what jumps out to me as being exciting. The whole point of leases here, we said up front, is that it's very similar when you take out a lease to buying an asset with finance. Finance means a liability in the balance sheet, which means an increase in leverage, an increase in financial risk. Where does that financial risk come from? The fact that you're making and are obligated to make in the future fixed payments that you cannot get out of. A lease is the same thing. It is a fixed payment that you cannot get out of. You're obligated to pay it. So in that sense, it is as important as knowing the debt that a company holds and the debt repayments it needs to make. So, as an analyst, I certainly want to look at these lease disclosures for the lessee and find out what they're committed to paying. If I'm doing any kind of credit analysis, it's huge. Any restrictions or covenants imposed by leases, fine. And any sale or leaseback transactions. Classic way of raising cash. Maybe you built your own office building or warehouse, to go back to our first example, but now you've decided you don't want to be running and managing a property, so you sell it to an investment property company who know what they're doing, but you still need to use it, so you lease it back. That's a classic sale and leaseback. Maybe done to restructure your balance sheet. Maybe you just didn't want to be involved in the property management anymore. For lessors, you've obviously got to split it. You'd expect this between finance and operating. Profit or loss you made on selling, fine. You want to know the income. You want to know income relating to variable lease payments not included in the measurement of the lease. So things that are dependent on contingencies going forward. Qualitative and quantitative explanation of changes in the carrying amount of your net investment. So what's happening to those lease receivables. And maturity analysis. Well, on the opposite side here, but you can see for finance and for operating down here, once again, it's very useful as an analyst to know in the future what payments are we committed to receiving. This is going to help us forecast cash flows. And they specify you've got to show from years 1 to 5 individually, at least, and then thereafter in total. For the operating lease, what was the income? Again, anything that may vary. Break it down into each class of PPE. Fairly straightforward. And a qualitative and quantitative information or set of information about leasing activities. So what do? How much of our business is it? Are we a leasing company, or is this something we do on the side? And if this is any kind of material part of our business, as an analyst, I want to know how the lessor manages risks. If we're a leasing company, these underlying assets are what we use to generate revenue, and we are giving them to somebody else to use. So how do we manage that risk, the risks associated with the rights you retain in the underlying assets? How do we know somebody's not taking the asset and running, for example? For employee compensation, well, post-employment plans, defined contribution again is not very exciting. What did we pay into the plan? That will be in the income statement anyway. End of story. For defined benefit, very different story. And without even reading these disclosures, just think about what you want to know. Think about what we talked about earlier. What was important? We had to calculate the present value of an obligation that's going to involve cash flows being paid out for the next 40, 50, 60 years? Well, I want to know how those cash flows are being calculated, what they look like, what the risks associated with them are, and how it's going to impact me as a business. Specifically, I was thinking earlier on about how changes in any of those actuarial assumptions could have a huge impact on the business. So that for sure is going to be required, a sensitivity analysis. Now, yes, I'm using a discount rate of 3%. What if I change the discount rate to 6%? What's that going to do to the balance sheet? What if I change my assumption of future salary increases? That will change the final salary, and so on and so forth. Apart from that, yep. Tell me everything that's in the financial statements related to this defined benefit pension plan. I don't see any excitement around that. Obviously, that's what you want to see. Tell me all the risks. Reconcile. This is always a go-to for any set of disclosures. What was it at the start? What was it at the end? Show me the reason. Show me what drove it. Show me every single line that moved me from my opening to my closing position. And give me some information about the plan assets by category. I said earlier on, you shouldn't see a huge amount of risk. You're really trying to match to a liability. The idea of the pension fund is not to get huge returns for the sake of it and take on risk. It is to match your obligation. So let me know how you're doing that, what investment or rather what asset classes you're investing in. And finally, disclosures on share-based compensation. Clearly, you'd like to know every type of share-based compensation arrangement that there are. What are the vesting requirements? Maximum term of the options. When do they last until and how are they going to be settled? Fair enough. And then, as I mentioned on the last page, what you'd always expect, a reconciliation of where we were at the start to where we are at the end. What was outstanding at the beginning and the end, and the reason or an explanation of how we went from the number at the start to the end, plus how many are still exercisable at the end of the period. That's options for other equity instruments granted during the period, how many, weighted average fair value, and how you've measured that fair value. Anytime there are huge assumptions around an accounting treatment, you're going to see required disclosures. And that's it. Obviously, the presentation disclosure at the end is not the main thrust of this LOS. Two main themes in here, leases and defined benefit pension plans.